This video, we'll be looking at step acquisitions, and step acquisitions mainly come in three most common situations. So I'll explain them on the screen and the treatment for these three common situations. Um, some are the same, some are different, but we'll explain as we move on. But what do we mean by step acquisitions? You're basically increasing your shareholding in a given company, and it will be shown in the three different scenarios here above. So mainly what's happening here is that you might move from what you would call a mere investment. What do you mean by a mere investment? It means you had a shareholding of less than 20% initially. Then you jump and become and you jump and increase your holding to a position of control. What do we mean by that? Control is where you get over 50%. Then yeah, most likely. So basically we can give a scenario like you are at 16% and then you jump to 50, just like what has been shown here. Jump to 60%. That is a step acquisition. What does that mean? You've just moved from a mere investment to what? A position of control. When you move to a position of control, what do you call the company? A subsidiary. That's how it is according to the rules of consolidation. Then the second scenario is where you move from a position of significant influence. What do we mean by that? That position that you would call a company an associate, because you're within the region of 20% control and 50% holding. That means you just have significant influence. So because of that, you'll be calling that company an associate. But you can also make a step acquisition from a company you're calling an associate to a subsidiary by maybe moving from 25% to 70. Those are the scenarios. The third one is you already have control. Like you've seen the figure I've used there on the third scenario, 55%. 55% is already greater than 50, meaning that company you're already calling it a subsidiary, but you still want to increase. You want to make a step acquisition. So you go maybe to 80. So that also is a step acquisition. You don't always have to come from below 50 to call it a step acquisition. No, let's understand this point. Even at subsidiary level where you already have control, you can also make a step acquisition. The only thing is that the treatment for the first two, let me highlight the first two just in case we're wondering. The treatment for all these, the first two which I've just circled in red, is the same, but the last one where you already have control just has got a different working. That's it. When you're dealing with step acquisitions, like the first two scenarios where we said moving from mere investment to subsidiary or control, or moving from associate level to a subsidiary, on those two scenarios, you need to calculate again or loss on disposal. Yeah, the first two, the reason is that you need to it's taken that you have sold off that previous holding, and you obviously have disposed it at a certain value. So what happens is that you need to calculate again by just basically looking at the proceeds that you've used to sell, which will be compared to the carrying amount of your previous investment. So carrying amount is just basically you would have most likely be told in your question that the value of your previous holding as at to date or as of to date is this much. So let's give an example. The value of your what this is at 50,000. Then they tell you that then it was disposed for, or it was sold at maybe 60,000. Yeah. So basically the difference gives you what? The carrying the profits all also on disposal. But if the proceeds are more than your carrying amount, then you've made what? A profit according to your basic financial accounting knowledge. This is a profit on disposal. Next scenario is um how do you now deal with the rest of the transaction? How do you deal with this gain? Okay, that you've realized. This gain is supposed to be posted in your retained earnings. Yeah, so any profits realized from a sale is taken to your retained earnings as one of the places to post it. Yeah, so make sure we take it there as well, as we'll be accounting for all this. Okay, so now the next calculation is goodwill. Why goodwill? Remember, when you've now moved from a position of mere investment, you do not need to calculate goodwill. According to the standard IFRS 3, it states that you can only calculate goodwill where control is in place, according to the standard. So, because of that, now that you have established control, you can now calculate goodwill. So, what are you going to do to goodwill with this new stepped up acquisition company? What you just do is you can get the cost of this consideration, like how much did you sell it for. Okay, so first of all, you get first. Let's talk about this the fair value. Sorry, let me just rewrite that properly. The fair value of the consideration, meaning how much you sell this. Fair value of consideration. Then the next one is add cost of additional investment. Costs of additional investment. Because this one comes in the fact that for you to gain more shareholding, you obviously incur the cost. So that has to be added to how that amount of proceeds that you sold. So like we said, you sold at what? You sold at 60,000. So you get your 60,000 here, and then you also add what was the cost of getting this additional number of shares that has now gained us control in this company. You also be given a question, maybe let's say 40. You even take them together, meaning the total cost becomes now 100. So when you're calculating goodwill, don't forget the procedure. It's usually the purchase consideration, which is now made up of these two components according to this scenario of step acquisitions. Then look at the net assets now, because when you're calculating goodwill, always consider the net assets as well. It's a key point as well when you're looking at your goodwill calculation. So get the net assets. You need to subtract the net assets at what? At acquisition. But be careful. Which acquisition are we talking about? Because remember, this company, when you are okay, let's say when you started dealing with this company, like we said, you came from a region of maybe not control, maybe you were at associate level, or you were just at mere investment level. So you're going to focus at the point when you've now acquired this control. So maybe let's give this example to understand this. Let's say you acquired this company in 2001. Then in 2012 you decide to do what? To increase that, to step up your acquisition. Okay, so in 2001 maybe you are 16%. Then in 2012 you say, okay, I think let's increase our holding to what? To 60. So what do we mean by the net assets at acquisition? You will look at the acquisition as of 2012 and not in 2001. The reason is that in 2001 it was a mere investment, and if it's a mere investment, it is not it's not supposed to be part of your consolidation, meaning you do not need to consider the net assets from an entity that was what? That did not have any control. So those are the things you need to look at. You look at the date when you've now acquired control, because when you've acquired control is when you can consolidate according to the standard IFRS 3 as well. So you can only consolidate when you have control. Hence, you look at the net assets figures as of 2012 only. Yeah, that's the catch here. So that's what we mean by, and the proper writing should be the net assets at date of what? That date of acquisition, the current date of the acquisition of this new control. Then once you list that part, then you have your difference to give you your goodwill. So what is the catch again from all this that we have mentioned? Make sure you pick the right dates. Do not go for the wrong one. You might end up calculating a wrong goodwill calculation. This is the catch for this. So this is like the most crucial working, I would say, during step acquisitions, because you now have goodwill to look at. As we said, your company was just maybe a mere investment, it was just an associate. In those scenarios, you don't need goodwill. Goodwill only appears where control is taking place. So this is one thing to remember. That thing I've added, that add NCI goodwill interest. They might tell you in the question, the NCI is interest in goodwill. This one usually comes in when you're dealing with what they call the fair value method of calculating goodwill. Yeah, in one of my videos, I think I've mentioned it. Just so you do to check it out as well. It should be in the intro to consolidation. Yeah, so these are like the key points during step acquisition: the goodwill calculation and the profit on disposal for the first two scenarios of where you're just coming from a mere investment, or you're coming from associate level to what? Subsidiary. Now let's look at this last one, where now you have already established control. What are you going to do in that scenario? Well, in that case, basically what happens is that your focus is on NCI. Why do we say that? Remember your group structure: the parent, the subsidiary. This side we even have NCI. Let's say we had 55% holding, meaning how much is NCI's portion here? 45%. Okay. Then we say, oh, let's increase our holding and go to 80%. So I'll put 80 now. What is our NCI value? 20. Whose portion has reduced here? It's the non-controlling interest, right? So that's why we're saying your main focus here will be the NCI. Why? When you already have control, you're just dealing with two people, the parents and the non-controlling interest. That's how it is according to the group structure. So when you want to increase your shareholding, who are you actually buying from? The non-controlling interest holders. So that's why the logic comes from here, and the focus goes mainly on the NCI. So NCI has to be reduced. How are you going to reduce it? We will deal with the system calculation, which is key to this, which they call adjustments to equity. It's the most important working for the where you've already got control and you're just stepping up your acquisition. Adjustments to equity. In this case, what you're just supposed to do in the adjustments to equity, you mainly first have to get the proceeds. The proceeds. What do you mean by the proceeds? The proceeds that you realize from the sale. Like we said, when you're selling, they should be like, how much was this so that you get. So that's your proceeds. After your proceeds, what next? After your proceeds, calculate the net assets as well at what date? At the date when this same step acquisition is taking place. This is very key. Also, as we said, so we have to come and list our net assets at the date of acquisition, step acquisition. If you want, you can put like that just for remembrance sake. Net assets at date of the date of step acquisition. You deal with that. Remember what the net assets made up of. If you're not given the word net assets, share capital, retained earnings, share premium, those are your net assets basically. Then when you get that in check, when you less from your proceeds, what's the next step at this point? When you've dealt with that, you need to now look at one more thing. Just a minute. So after you've dealt with this, so let's like make a format of what we're talking about. So you deal with that. So we said net assets at what? At acquisition. You calculate them. Just a minute, I haven't written them properly. So once you've calculated your net assets at acquisition, do not take them into that far column yet. First put them on this side. Then you're going to get a percentage of NCI from these net assets. What do I mean by a percentage of NCI? Basically, the standard says get the portion of NCI. What that just means is that you're going to get the portion of NCI that is being sold off. So like, how much are we selling off? Remember, we're moving from 55, just an example, to 80. How much have we sold off? If you look at this difference here, you've sold off how much? About 25% has been sold off if you've calculated properly. So hence that 25% is what you're going to charge on this net assets total. That's how you would deal with this scenario. So be careful on this one, or you can write yourself a point that you're getting a portion of the NCI that has been sold off. I'm just writing this for you so that you can take note of this. That has been sold off. This is just like simplified. The standard doesn't even write this statement for you. It just says the portion of NCI sold. So that's like that. So you would get that it's 25 in our case. So you go and charge 25% of whatever net asset figure. Then once you do that, you take this 25% right here. I think let me change the colors for easy following. Follow the yellow marking there on the screen. That's why you take your 25% portion and subtract it from this proceeds on top waiting. On that difference, when you reach this difference that you have found, you are required to do the next calculation. Like I told you in the previous scenario, you might also be told in the question that the NCI is goodwill interest. So like we saw in the previous scenario when we were talking about how you would calculate goodwill, if you've been given the NCI interest in goodwill, the question will tell you that, yeah, it will be clear, the NCI interest in goodwill. What you're supposed to do in a scenario like this one where you already got in control, then you're stepping up like what we're dealing with right now in the adjustment to equity, the next thing that you need to do to that NCI interest in goodwill, you need to get a fraction of it. Let's say the NCI goodwill was 100. And then we are selling off 25%, right? Over what? You need to make not over 100, but it should be over 45. Why 45? Remember, initially we had 45% NCI when the group structure was at 55%, right? Now that we have moved to 80, it's like we have sold off 25% of that 45. That's the understanding that's there. That's why we don't make it over 100. No, it's over that 45 because you are looking at the 45 that you've sold. So hence you use that fraction and multiply it to this NCI interest in goodwill, because it's like you're also partly selling off that goodwill that you have, as if you understand the logic. Then when you do that, you actually get to, when you get that figure, let's say you get this figure of NCI interest in goodwill, then you include it here in your working and subtract it. As we said, we have sold, let's understand this, we have sold off, and then it gives you a certain figure here. This figure is what we now call the adjustment to equity. This same figure, adjustment to equity amount, because this whole working, like we started from the beginning, it's the working for what? Adjustment to equity. So once you collect this figure called adjustments to equity, what do you take it in your consolidation? It just goes on two places. One, take it to NCI working, that should be working number 4, and do what? Add it and go to the group retained earnings working number 5, and less this figure. Okay, so take note of these two places where you take this adjustment to equity. You what? Take it to NCI, add it, retained earnings, you will do what? You will subtract this amount. It is as good as them they are receiving the cash. This adjustment to equity, just picture it as money. I think that's the best way you understand why we're adding here, why we're subtracting. Picture it as money. You have sold off. Who's receiving the cash? NCI. You get quite right. Their shareholding has also dropped, but we're looking at money, like you said, picture it as money. So the money has come to the NCI, hence we're adding. But to your company, your earnings will have to drop because you've spent to get that you get. So that's the reason why we do this. Then once you do that, you now just do your normal consolidation workings. Nothing really changes here. Like we said, the catch here is these major adjustments during the step acquisitions. So even when you like we said, even when you've moved from control to just increasing, like this same third scenario, or just from looking at which just requires you to have this major working called adjustment to equity, you go back to the normal workings that you know. You do your net assets, your goodwill. It's basically the same things. Yeah, the same things. So maybe the only thing that would have to just look at is I think issues of what? Maybe if you're looking at issues of how you calculate your share of PAP, because there's this small timeline that can help you, if anything, when you're calculating share of PAP. You would see this is the time when you started with your company, maybe at 55%, right? Yeah, you started with your company at 55%, and maybe you had a certain retained earnings figure at that date. So you would consider all that. This is what we're doing called date of acquisition. Then this is your reporting date at the find. So now at your reporting date, as we said, it will come and appear that you've now increased your holding, your shareholding. But the shareholding, let's say it happened midway. Usually this is when it can happen before you report. You find that you had a new stepped up acquisition somewhere, which is now looking at what, which is now at 80%. So what you'll be doing is that at this portion here, I'll put it in green. This portion here, the share of PAP you're using is, you'll be multiplying 55%. Why? Because this is a period before 80. So you just have to take note of the period. I'm just giving you a tip. Then this period from 80% to this period now from 80% onwards to the date of reporting, you'll now be using 80% to charge your share of PAP for the parents holding. Same story with the NCI's share of PAP. At this point, it would be at 45 if you're getting the logic. Then at this point, after you increase to 80, you now charge 20% for NCI share of PAP. So you'll be having two share of PAPs, but nicely apportioned like this, because you're noticing the time period before you had your, what's this, your step up and whatnot. Yeah, so this is the catch, and these are the major adjustments to take note of. Remember one thing, when you're dealing with the NCI, I just told you, yes, you should go and add the adjustment to equity. Don't forget to also subtract the that proceeds that you sold at. They'll give you a figure that you sold this at that much. Just make sure you list that, because it's like double counting if you do not do that. So just take note of these things, and the rest of the consolidation is as you know from your simple group structures. It just continues from there with just these few adjustments. So that's the video on step acquisitions. Hopefully you'll learn one or two things from this.